Worst day for the S&P and Nasdaq since May. Dow now negative for Q3. Steve Weiss, going to you first because your stuff jumps out to me big time today. You're shorting Micron. You're shorting the SMH. You're shorting the S&P 500. And you have puts in the ARK funds as well.
Right. And so I came in with those positions. I've also hedged some of my other positions and have some shorts on. Look, Micron I'm going to cover before the close because I think negativity is all there, although I could be fooled like with FedEx where I thought it was negative and yet it went down further. My view in the market has been pretty consistent that I just don't see the positive catalysts ahead. I see lots of negative catalysts, but I'm hard-pressed to think of anything positive. And let me just go through a few of them. First of all, retail, as we see from the flows, have stopped buying the dips the same way they were in past years, number one. Number two, supply chain issues have worsened. Labor issues have worsened. And when you see that filter through to companies, and a number have already had down earnings for 22 versus 21 because you're through the post-pandemic push, that you're going to see margin compression throughout every sector virtually, maybe not energy at this point, but through most other sectors. Plus, you've got a yield that keeps moving higher. When I was on the show last week, you quizzed me about my view that we're going to get to 165 on the 10-year. We're going to get there sooner than even I thought. So all these are conspiring basically to keep the market under pressure. Now, I think we'll get a short-term pop when we agree to fund the country. But after that, it's just going to be more of the same. It's going to be a disappointing earnings quarter, and we're not used to seeing those. So I prefer to keep my exposure low, to be out of low-quality names that are trading on a whim and a prayer, that don't have valuation to rest upon. So I'm keeping my exposure low and being very cautious.
So Jim Lebenthal, Farmer Jim, Mr. All In. I'm going to call you that because right now you have zero cash. You have zero cash and a big smile on your face. And you say, don't be thrown by the move in the 10-year. So when you hear Weiss lay out what he sees in the market, do you want to just completely counter all of that?
Yes. Yes. I mean, my good friend Steve is sort of picking the facts and inflating them to make it sound like the conclusion he's drawn is the correct one. I think he's absolutely wrong. I mean, let's start with the most important thing, bar none. Delta has peaked in the U.S. I talked about that, and basically all I was doing was parroting Scott Gottlieb a month ago. But it has peaked. The numbers clearly show it. And as that peaks and as people gain confidence, which there has been shown to be a very tight correlation between consumer confidence and the rise or decline in the COVID cases, you will see people come back out of their homes, start traveling again. You're already starting to see slight signs of improvement in air travel. The reopening will continue apace. And you look at these stocks, whether it's airlines, casinos, hotels that have been really, frankly, slaughtered from May until just last week. That's where the opportunity lies. This is not a time to hunker down. Now, where Steve is correct, and I'll grant him this, there is near-term volatility. We're seeing it, all right? We're right back to where we were on Monday. And what's the source of that volatility? It's Washington, D.C. I have been through many episodes of the government shutting down. I have been through many episodes of the debt ceiling debate. In all cases, they have resolved themselves positively. And in all cases, it's moment exactly like today's, where you are supposed to step into the breach.
I don't think that's right.
Where do you differ? I mean, factually, where do you differ? Every time the government has shut down, it has reopened. Every time the government has shut down, it has reopened.
Exactly, which is why I don't think the sell-off has anything to do with what's happening in Washington, D.C., because we've seen this movie 1,000 times before, and we know exactly what's going to happen. The crazy thing is you didn't even mention the move in interest rates. You didn't mention the move in interest rates.
Well, let's go there.
We've had a huge... Well, shouldn't we go there first?
Going on.
Shouldn't that be the first thing we talk about? That's what's driving the markets.
No. Well, listen, we're going to disagree. And you and I, right now, we're talking opinions. We're entitled to disagree, but they are opinions. However, you are correct that interest rates matter. Is there anyone here who didn't think that interest rates were going to go up from 1.2%? They're at 1.54%. These are not exactly nosebleed levels.
Did you think
Frankly,
they were going to go?
These are levels that help the financials.
Did you think it was going to go that fast? Because that's the story. It's not the level. It's the pace.
Scott, I don't think this is that fast. I mean, let's just stop right there. I don't think it's that fast. It's fast enough to knock the market down 2% in a day, to which I say big deal. And if you're not invested right now, this is the time to buy, not the time to sell. I don't know if I can make that point any clearer. The economy is in very strong shape. Profits are high. They are growing. Those profits get recycled in the form of capital expenditures and hiring. The Fed is still accommodative. We are likely, not definite, but likely to get infrastructure. To me, the positives very far outweigh the negatives, and a move of 20 basis points in the 10-year just doesn't throw me from that conclusion.
All right.
You're supposed to be all in right now. You're supposed to be all in on cyclicals.